Copy. The loudest debates in crypto are usually about prices. Which coin is going up, which project is going to zero, which influencer is right and which one is wrong. But right now, in 2026, the most important fight happening in the entire digital asset space has nothing to do with prices. It is happening in congressional hearing rooms, in regulatory agency offices, and in quiet negotiations between the White House, the banking lobby, and crypto companies. The fight is about something much more fundamental than which coin wins. It is about who gets to write the rules of the next financial system, and whoever wins that fight will determine how money moves, who profits from moving it, and which companies get to exist inside the most powerful financial market in the world. If you want to understand where crypto is actually going, stop watching price charts and start watching what regulators are doing. Because what they are doing right now is the most consequential shift in financial policy this industry has ever seen. Let's start with Project Crypto, because this is the framework that ties everything else together. Project Crypto is an initiative by U.S. financial regulators to fundamentally modernize the rules governing digital assets. And to understand why this is significant, you need to understand what came before it. For years, the dominant approach to regulating crypto in the United States was what people in the industry call regulation by enforcement. That means there were no clear rules written specifically for digital assets. Instead, regulators, particularly the SEC under previous leadership, would wait for companies to act, then sue them and argue that existing securities laws applied. The result was a market where nobody knew exactly what was legal and what was not. Companies could not get clear answers about whether their products were compliant. Banks could not touch crypto without risking regulatory backlash. Institutional investors stayed on the sidelines because legal uncertainty is incompatible with fiduciary responsibility. Project Crypto is the attempt to replace all of that with something better. The idea is straightforward. Write new rules that are specifically designed for blockchain technology and digital assets so that companies operating in this space know exactly what they are allowed to do, which regulator they answer to, and what compliance actually looks like. That shift from enforcement to rulemaking sounds procedural, but it is one of the most important policy changes this market has ever seen, because clear rules are the prerequisite for institutional capital to enter any market at scale. One of the central challenges that Project Crypto has to solve is a definitional one, and it matters more than most people realize. Right now, there is genuine legal ambiguity about whether a given digital asset is a security, meaning it falls under SEC jurisdiction, or a digital commodity, meaning it falls under CFTC jurisdiction. This distinction is not just academic. It determines which rules apply, which regulator you have to register with, what disclosures you have to make, and how much compliance infrastructure you need to build. For most of crypto's history, this question was answered through litigation rather than legislation. The SEC argued that most tokens were securities. The industry argued they were not. Courts gave inconsistent answers. The result was that the U.S. crypto industry spent billions of dollars on legal fees fighting about a definitional question that should have been answered by Congress years ago. What is now being worked on, through both the regulatory process and through legislative proposals like the Clarity Act, is a framework that draws a clear line. Assets that function like investment contracts in an issuer-dependent company would be regulated as securities. Assets that function more like commodities with decentralized networks and no central issuer would fall under CFTC jurisdiction. Getting this right matters enormously, not just for compliance, but because it determines the entire business model of every exchange, every custody provider, and every institutional product built on top of these assets. Now let's talk about the Clarity Act and why it is currently stalled. Because this is where the political and financial dynamics get genuinely interesting. The Clarity Act is a piece of legislation designed to do exactly what the name suggests: provide legal clarity for the digital asset market. It passed the House with significant bipartisan support in 2025. It should have been a relatively smooth path through the Senate, but it is stuck. and the reason it is stuck tells you a lot about the real power dynamics at play in this debate. The sticking point is stablecoin rewards. Here's the issue. Crypto companies, particularly exchanges like Coinbase, want to offer their customers yield on stablecoins. If you hold a stablecoin on their platform, they want to be able to pay you a return, similar to how a savings account pays interest. The banking industry has pushed back aggressively on this, arguing that allowing crypto platforms to offer yield-bearing stablecoins without banking regulation is unfair competition and potentially dangerous. Banks are subject to capital requirements, deposit insurance rules, and strict oversight specifically because they hold customer deposits and pay interest on them. If a crypto exchange can do functionally the same thing without the same regulatory burden, that creates an uneven playing field, and, the banks argue, a systemic risk. This is not just a policy disagreement. It is a direct conflict between two industries fighting over the same customer and the same dollar. The White House has been actively involved in trying to broker a compromise. The expectation is that some kind of deal gets made, but likely one that neither side finds entirely satisfying. And if those negotiations collapse, there is already support in the House to pass the original version of the Clarity Act that cleared in 2025 without the Senate modifications. Either way, some form of this legislation is coming. The question is just what shape it takes and which industry comes out with the better end of the deal. Here is a part of this regulatory story that almost nobody in retail crypto talks about, but that institutional investors understand very well. Perpetual futures markets. A perpetual futures contract is a type of derivative that lets traders speculate on the price of an asset without an expiration date on the contract. They are enormously popular in crypto because they allow leverage and hedging in ways that spot markets do not. The problem, from a U.S. regulatory perspective, is that perpetual futures for crypto never developed inside the United States. They grew up in offshore markets, primarily in Asia and Europe, and on platforms based in places like the Bahamas, specifically because the U.S. regulatory environment made it impossible to offer these products domestically with proper investor protection frameworks. The result is that billions of dollars in daily crypto derivatives volume happens outside the United States, outside U.S. regulatory oversight, and outside the reach of U.S. consumer protection laws. Regulators at the CFTC are now actively working on frameworks to allow regulated perpetual futures products to be offered inside the United States. This is significant for two reasons. First, it would bring a massive amount of trading volume and market activity back into U.S. regulated venues, which means more oversight, more investor protection, and more tax revenue. Second, it signals that regulators are no longer trying to keep crypto out of the U.S. financial system. They are trying to bring it in on regulated terms. That is a fundamentally different posture than what we saw in previous years, and it changes the calculus for every institutional player who has been sitting on the sidelines waiting for regulatory certainty before allocating capital. Let's zoom out and talk about why the United States wants crypto markets back inside its regulatory framework. Because the motivation here is not just about investor protection, it is about geopolitical and financial competition. For most of crypto's history, the dominant narrative was that the U.S. was hostile to crypto and that innovation was fleeing to friendlier jurisdictions. And there was truth in that. Regulatory uncertainty pushed companies and liquidity offshore. But what regulators have come to understand is that allowing a multi-trillion-dollar asset class to develop primarily outside U.S. jurisdiction is not a neutral outcome. It means less visibility into systemic risks. It means less ability to enforce sanctions and anti-money laundering rules. It means U.S. investors are participating in markets that operate under foreign rules. And it means that the financial infrastructure of the future is being built in places where the U.S. has less influence. The shift happening now is a recognition that the better strategy is to establish the U.S. as the dominant regulated jurisdiction for digital assets, the same way the U.S. dollar dominates global trade, and the same way U.S. capital markets attract the most institutional capital in the world. If the U.S. can become the gold standard for crypto regulation, companies will want to be registered here. Investors will prefer U.S. regulated venues, and the infrastructure of digital finance will be built under American rules. That is a very different goal than trying to suppress crypto, and it explains why the tone from U.S. regulators has changed so dramatically in a relatively short period of time. Now let's talk about what all of this means for crypto infrastructure assets, and specifically how something like XRP fits into this regulatory landscape without making any exaggerated claims or price predictions, because that is not what this analysis is about. XRP and the Ripple network were designed from the beginning to solve a specific institutional problem: cross-border payment settlement. The XRP ledger is a regulated, high-throughput blockchain that can settle transactions in seconds, and that has been specifically built for compatibility with the traditional financial system. Ripple, the company behind XRP's institutional adoption, has spent years and significant resources obtaining regulatory licenses across more than 75 jurisdictions. When regulators talk about bringing digital asset infrastructure into a clear regulatory framework, the assets and platforms that are already operating within regulatory frameworks are the ones best positioned to expand their institutional footprint. The reason this matters in the context of the Clarity Act and Project Crypto is straightforward. If regulators define a clear category for digital commodities and payment assets that do not function as investment contracts in a centralized company, assets that have genuine utility in a decentralized payment network occupy a much clearer regulatory position than assets that lack that utility. The institutional adoption story for XRP is not about speculation. It is about whether regulated financial institutions will increasingly use blockchain infrastructure for payment settlement, and whether the regulatory environment will allow that use case to scale inside the United States. Regulatory clarity does not guarantee any outcome for any asset, but regulatory ambiguity is the single biggest obstacle to institutional adoption at scale, and removing that obstacle changes the environment for every legitimate infrastructure-focused project in the space. Here is the bottom line on everything we have covered. The United States is in the middle of a genuine, meaningful shift in how it approaches digital assets. The era of regulation by enforcement, where companies operated in a legal gray zone and regulators responded with lawsuits, is ending. What is replacing it is a framework-based approach that attempts to define what digital assets are, which regulator governs them, and what rules apply to the businesses that build on top of them. The Clarity Act, Project Crypto, the push to bring perpetual futures inside U.S. borders, the new guidance coming for DeFi systems and digital wallets, all of these are parts of the same larger project. That project is the integration of digital asset markets into the formal structure of U.S. financial regulation. This is not a guaranteed win for crypto. The outcome of stablecoin negotiations, the final shape of the Clarity Act, and the specific rules that emerge from the CFTC and SEC rulemaking processes will determine whether the U.S. becomes the dominant hub for regulated digital finance or whether companies and capital continue to operate offshore to avoid regulatory friction. But the direction of travel is clearer now than it has been at any point in this industry's history. The question is no longer whether digital assets will be regulated. The question is whether the regulations that emerge will be designed intelligently enough to enable innovation while protecting investors and maintaining financial stability. How that question gets answered over the next 12 to 24 months will shape the structure of digital finance for the next decade. Pay attention to the rules, not just the prices. The rules are where the real story is. This video is for educational purposes only and does not constitute financial advice. Nothing discussed in this video should be interpreted as a recommendation to buy, sell, or hold any financial asset. Always conduct your own research and consult a qualified financial professional before making any investment decisions.